Hey, hello, welcome. Good afternoon, folks. My name is Jason Hamilton, and I just wanted to hop on today to hopefully relieve some of your fears about what's going on in the market right now. And in all honesty, just have an honest discussion with you. And I just see so many people absolutely freaking out, and I just want to bring things back to reality, right? So the title of today's workshop is, can we predict the stock market returns 100%? And in all honesty, the answer is no, right? So we can never predict stock market returns. But I have a question for you is like, if you're investing in the market and you have money in the market and let's say you made 20% or more of last year, do you ever think it could come down, right? And it could reset, So I think sometimes we forget to remind ourselves that the market is cyclical. There's a very serious thing going on right now, right? They're calling it the coronavirus. There's not necessarily a cure. Things seem like they're getting better. The markets can open up tomorrow, but neither you or I or anybody else can 100% control what that's going to look like. But what we can control is how we respond, and how we react to these things. And that's what I really want to talk about today. So I do remember I think it was Wednesday or Thursday, I hopped on and chatted with you guys. I brought up the statement of bring the data and not the drama, right? So I want to talk a little bit about some data today and try to relieve some of the drama because if you are a couple things actually, so if this time when we have this coronavirus going on and the market's down, I don't know, 7-8% at this point, and it's completely freaking you out. Okay, and you're completely stressed out and you're wondering, can I retire next year or should I have retired last month or anything like that, then that's an absolute indicator that you need to be looking at your investments because so many people have just kind of put things in the market and the last decade have done overall pretty well and they really don't have any structure, any strategy, any diversification plan, really anything. They just kind of throw it into whatever index fund or whatever, a target date fund that they have available at work, but they're not really looking at defending themselves against potential downsides. So this should be a reality check for you, right? This should have you thinking and questioning, are you in the right position for your investments? If you are going to be retiring soon or recently retired, and again, you're worried about this and it's been, a week or so of things being a little bit wonky in the market, that tells me you're probably not set up right? And or no one's ever really sat with you and helped you understand how to set parts of your portfolio for money today, parts of your portfolio for money down the road, because there's always going to be volatility, right? The reason why you get above CD returns or above bank savings account returns is because you're taking extra risk. Right? That's why we receive higher than average returns from the market because we're willing to accept that risk as investors, right? So these are things that are built in, but I think we just have forgotten about them, to be honest. And we really want to get back to looking at, or getting away, I should say, from recency bias, right? So a lot of people have a very recency bias. They forgot what happened in 2008, 2009. They forgot, like, go back and watch some of these news stories from back in those days. They're all on YouTube. Even watching those today, I started thinking to myself, I was watching these a few weeks back, and I'm like, I would probably be freaking out a little bit myself, when what was talked about in 2008, 2009, because things were really bad. In all honesty, we don't know how bad this coronavirus deal is going to be. Honestly, we don't, right? But at this point, just the numbers just don't justify, what's going on currently probably in the global markets. Could we have a slowdown for the first quarter of this year, maybe even second quarter? Sure, but do we think it's going to be this worldwide pandemic where we have zombies roaming the streets and everything's going to come crashing down and the only thing that's going to be worth money is guns, bullets, and bottled water? Probably not, right? It might be more serious than the flu. From the articles I'm reading, people that have it said the symptoms weren't even as bad, as the flu that they experienced. And just like with any sort of disease, people that are at higher risk. So some of you folks here might be at higher risk, right? They say people that are above 65 and also those with pre-existing conditions have a higher risk to things like this coronavirus, but that's no different than anything else really going on. So I just want you again to bring the data, not the drama. When you're investing in companies, right? When you're investing in stocks, what should be really determining a good investment is the company making money, right? Are they making profits? Are they delivering profits to their shareholders? Because that is what makes a stock worth money. So if you have a bunch of kind of expectation type of stocks where the companies aren't making any money and you're just hoping they go up based on rumors, then you're going to have a problem. Think about companies like Uber and WeWork, right? They've had massive problems in this last 6 months or a year because they just weren't making any money, and it's hard to constantly build on momentum, hoping that someday you're going to turn a profit. Because in reality, if companies don't turn a profit someday, they're eventually going to go out of business. You can only get funding for so long. So I want to talk a little bit about, some of the recent times and some of the things we've seen in recent eras when it comes to history and the stock market having some volatility. So let's bring this up here real quick. Let me share this with you. Okay. So I'm going to talk a little bit about the history of some market ups and downs. Okay. Let's talk about this a little bit here. All right, so hopefully this is coming through okay. Looks like it's good on my side. Okay, cool. So this is a history of the market ups and downs from January 1926 to December 2018, okay? So we've had plenty of increases. This was the 1928-29 stock market crash year, so things went down 83% for 34 months. So that was pretty stressful. And then what happened after that? For the next 167 months, the market was up 815%. And then it was down 22% for 6 months. And then it was back up 491%. And then down, 10 and 15%, 7 months and 5 months here. So, I think we forget that over time, many worse things have happened than this before, right? Again, I don't know how bad this is going to be. So maybe this coronavirus turns out to be worse than any of these things and the whole world turns into a global pandemic. It doesn't seem that way so far. We have very few people that are outside of China that have passed away. And again, most of them had some sort of thing like where they were above a certain age, like above 65 or their pre-existing conditions, right? But when you're looking at, the whole, and the United States has about 330 million people at this point. I know there's some cases, I think the first person just died in Washington. But in reality, it's not like the world's melting down, right? It's not like the world's melting down at this point. And look at, kind of our most recent run here since 2008, 2009, where we hit a bottom of 51%, and that was over 16 months. Then what happened? This is what I think people are getting freaked out about because, we had a little dip in 2018, right? This is kind of, if you can even see it here, about 14%. But this is what we're probably used to. We probably already forgot about 2018, and we probably remember 2008, 2009. But things have been so good for so long. So when things come down and we're sitting at 8, 10% down, it might go down further. I don't know. But when you look at the course of 100 years, I just really think using this data and trying to reduce some of the drama at this point is probably a good idea. And again, revisiting your allocation. If you are currently set up improperly in your portfolio and you're completely freaking out, then you probably should be revisiting your allocation. This is a good time to be thinking about it. Should you go selling everything off? Probably not. Have you lost any money currently if you haven't sold? No, you haven't, right? So that's what you have to remember. If you haven't sold anything yet, you technically haven't lost any money. If you sell, then technically you're locking in your losses, okay? And so that's going to be a personal choice. At this point, I don't think you should be selling anything yet. Maybe you should be buying at this point. Maybe you should be rebalancing, purchase some things at a little bit of a discount. There's some good deals out there potentially, right? But I don't think now's the time to be freaking out, moving everything to cash, and just watching what's going on, right? Really paying attention. So this is a cool graph that I saw. Here's another one I want to share with you here. Let me go over to this one. Okay, so here's the other thing I want you to look at. How reacting can hurt performance, okay? So this is the performance of the S&P 500 index from 1990 to 2018, okay? So over 28 years, okay? So if you had $1,000 and you were in the market in 1990, and then by the end of 2018, if you didn't take anything out of the market, you just left it sitting in there, your $1,000 would have turned into $13,137. So you would have had a compound annualized return of 9.29%, okay? If you would have missed the one best day, you would have lost out on just about 0.5% of return. So you would have lost out about, $2,000. What the heck? Sorry about that, guys. That was weird. Okay. If you missed the 5 best days, well, and this is average. This is annualized compound return. This is your average return per year over that time, you would have gone down from 9.29 to 7.75 just by missing the 5 best single days. Okay, if you would have missed the 15 best single days, you would have had an average return of 5.79%. Average, okay? You're going from 9.29 to 5.79 just by missing the 15 best single days, okay? You miss the 25 best single days, and now you're down to less than half of the annual return from just missing 25 days out of 28 years, okay? So this is the thing, guys. This is the thing. I know some of you are stressing out, okay? I know some of you are looking at your portfolios and you're down 5,000, 15,000, whatever that number is, okay? But if you look at that previous graph, and if you would have missed 15 or 25 of the best days in 28 years, you would have gotten less than half of the return, okay? So I'm not telling you what to do here. I'm not saying that you should keep your money or take your money out. I want you to do what's best for you, okay? But I don't want you to make bad decisions. That's the thing. So I want you to really be thinking about, is what's going on right now worth going back on whatever investment strategy you set, right? Like if you're setting an investment strategy, it's ideally something you should be putting in place for the next 5, 10, 15, 20, or 25 years. I'm not saying you can't make slight adjustments along the way. And actually, I think as a country, we are realizing, this is actually a wake-up call, honestly, is what I'm seeing, is that we're way too reliant on China, right? I heard a story, and I don't know if this is true, it's just a story I read, okay? I read it on the news, I didn't verify it. But I read that there was a boat coming our way that was supposed to have something like hundreds of millions of masks, right? Like a mask, so that if, that apparently don't really work that well anyways. But, masks that we could use to potentially cover ourselves, to protect ourselves from the coronavirus spreading or whatever it may be. So what I read in this story was that the boat was on the way here for masks to be provided to Americans, right, from China. And the Chinese called for that boat to be turned around because they needed the masks worse than us, right? So this is what happens when you don't control your product development, right? And so I think this is really a big wake-up call, that we as a country need to really be thinking about not relying on outside resources for most of our supplies. Of course, we want to have trade. Of course, we want to interact with other countries and buy and sell things. That's part of a global economy. I think it's a wonderful thing to do. But we have become very reliant on China and very reliant on cheap goods. And again, it's why things have stayed down so far, right? You go shop at Walmart, it's pretty amazing. I don't go to Walmart very often, but I went there a few months ago, and it's amazing. You can buy shirts for $8 and $10, right? For a shirt, actually not too bad looking of, quality either, by the way. But you go to, other places, like Nordstrom or whatnot, and you can't buy a shirt for less than $50 or $80. Some shirts were like $100 for just a basic shirt like this. Absolutely crazy. But, these are the things that you give up when you don't control the means of all these different, types of materials and just really wanting cheap goods. So the way I'm seeing this is that we need to look at this as a wake-up call, and we can't be as reliant on one particular country to produce our goods. Because we can end up in a situation like this, and then that's when we lose control, right? And so that's the risky part. But, there are people, I read an article from JP Morgan Chase thinking that this quarter for China is going to be really bad, but they think in Q2, once this coronavirus is basically cleared up, that China is going to have about a 15% growth. So, and nothing generally lasts forever, right? Especially if you're looking at the markets. I mean, if everything goes to complete heck in a handbasket, right? Then, like I mentioned when I first opened this, is the only thing that's going to be worth money is bullets, gold, and bottled water. But if long as markets are still opening, and honestly, I was at Target yesterday, the store was full, okay? People are still driving around the freeways. I know some events are getting canceled for risk and things like that. But, I have a vacation planned next weekend where I'm going to go down to San Diego for a couple of days and spend some time with some colleagues and some friends. I'm not canceling that over this. I think if you give in too much to some of these fears, then that's when it's really gonna, be giving you the effect that some people are trying to put out there. So I don't think the numbers justify it yet. Again, just like I said, bring the data, not the drama. Don't take my word for it, okay? Do whatever you want to do. All I'm saying is if you look over the last 100 years, and then like I mentioned, over even the last 28 years, if you're making decisions about jumping in and out of the market based on these news stories when 2 weeks ago it was about the same things were going on and you didn't do anything, right? Until the media started going in this frenzy. I just want you to be smart, okay? That's all I'm trying to do is help you be smart, make good decisions, stay calm until we have more data, right? Bring the data, not the drama. I would say that it's time to just stay focused still, stay calm, and don't make any irrational moves. But if you are feeling completely stressed out, then you should be visiting your investment strategy, because this, whatever your investment strategy is today, is probably not right if you're having a complete meltdown about things that are going on. So if you want help with that type of stuff, we're happy to help you out. I'll put my link down in the comments if you guys want to schedule an appointment. If you want to go over your portfolio and make sure that you are properly allocated, I'd be happy to chat about that with you. Other than that, I'm going to sign off for today. Wish you guys an excellent day, an excellent weekend. We'll see what happens tomorrow, right? I mean, the markets are going to open back up, and we'll see what happens tomorrow. So we don't know anything yet. But for today, let's think about what we can do, what we can control, and that's really ourself, our behavior. Until we know more data, let's just keep things where they are and don't do anything too crazy. All right. Have a good afternoon, folks, and we'll talk to you next time. All right. Bye-bye now.